This is Asia Tradum Shery in Tokyo.
I'm Avril Hong in Singapore. The top stories this hour. Asian stocks set for opening gains as Wall Street notches a new record. Investors largely shrugging off the U.S. government shutdown. Treasuries rally as jobs data reinforces bets on a Fed rate cut this month. President Trump planning to use the shutdown for mass layoffs of federal workers while cutting funding for green energy projects and New York infrastructure. Also ahead, Samsung and SK Hynix strike a deal to supply chips and other gear to OpenAI's Stargate project. Plus, we kick off our live coverage of Token 2049 in Singapore, speaking exclusively to Coinbase Chief Business Officer Shan Aggarwal.
Despite all of the risks in the market, we continue to see the gains in the U.S. stock markets. We are talking about healthcare also rallying in the overnight session, shrugging off the U.S. government shutdown with that deal from Pfizer and the Trump administration that could help the company circumvent those pharma tariffs. Still, the concerns are there about the longer-term prospects of the labor market, especially since we saw private payrolls dropping unexpectedly in the month of September. And remember, this is coming after the job openings data also showed that hiring was slowing down. We had also U.S. manufacturing output falling for a seventh consecutive month. So we saw all of this haven demand in the Treasury space. We also saw gold rallying to record highs and the U.S. dollar under pressure. Now, the U.S. dollar has led to emerging market assets continuing to gain ground, but not necessarily for the Korean won pressured because of those exports slowing. Of course, we have the U.S. tariffs to contend with, and we're getting right now the trade surplus numbers again narrowing for the month of September. We're talking about $9.4 billion, and the current account surplus also narrowing to $9.14 billion. When it comes to consumer demand, we have seen that pressure on inflation prices. This time around for September, though, consumer prices rising 2.1% year on year, beating expectations, and excluding fresh food, excluding energy, rising 2% year on year. We are coming off from a lower base, so we continue to see those gains in inflation numbers in South Korea outpacing the Bank of Korea's 2% target. But I mentioned how the U.S. dollar has been under pressure. We're talking about the longest losing streak this month, and that really leading to those gains on the other side of the Japanese yen, which at one point broke through the 147 level. We are watching the 10-year auction today as well, so do watch out for JGBs. Remember, the China mainland markets are away on holidays, but we continue to watch different sectors that could take a hit given, of course, the ongoing tariff news and, of course, a government shutdown in place in the U.S., Avril.
Yeah, let's get you the latest on the U.S. government shutdown and the Trump administration moving quickly to capitalize on the situation by shrinking the size of the federal workforce.
There are unfortunate consequences to a government shutdown, and the federal government is not receiving any cash at the moment. And so the Office of Management and Budget has been tasked with looking over the receipts and looking over the budget of the entire federal bureaucracy. And as the vice president said, determining what needs to continue to go out the door and what can we continue to keep running and what unfortunately is going to have to come to an end. So those decisions are being made. And unfortunately, layoffs are very likely, as the vice president just said, going to be a part of that.
For more, let's bring in our Congress reporter, Caitlin Riley in Washington. So, Caitlin, day one of the shutdown, we look like we're headed towards mass firings?
Yes, that's correct. As you heard the press secretary say earlier today, the administration is moving forward with firings. We knew that was a threat heading into this. We had seen agencies shut down plans in the days leading up to this, and they hadn't included any firings. But now we know that those are, in fact, coming, which we heard from the press secretary. And you're seeing kind of an escalation of tactics from the Trump administration as this shutdown drags on beyond the first day.
We also heard about President Trump freezing federal funding for New York, not to mention also withdrawing some projects when it comes to those states that voted for Kamala Harris. We are hearing about criticisms of using the government shutdown as a pretext for culture wars at this point.
Yeah, absolutely. And what's notable about the funding that was slated for New York is the top Democrat in the Senate and the top Democrat in the House, who have both been leading the shutdown fight, are both from New York. And so I know Democrats are seeing this as retaliation. The administration has said it's part of a review of that funding related to kind of cultural war issues, sort of diversity, equity, inclusion funding. And so we're seeing things ramp up.
It looks like both sides are digging in, as you alluded to. Talk to us about the Democrats' policy demands and how the Republicans have responded so far.
Yeah, absolutely. Democrats are asking for Republicans to agree to roll back Medicaid cuts that they enacted earlier this year. That's a healthcare program that primarily serves the very poor. Democrats also want to see an extension of healthcare subsidies that are due to expire at the end of this year. Republicans have said that they will not negotiate on these demands until the government opens. But we are seeing some bipartisan talks among rank and file senators where you might see some overlap, particularly on the healthcare subsidies that are due to expire at the end of this year. There seems to be the possibility for some bipartisan agreement there, though, of course, nothing has been forthcoming yet, and leadership has insisted that they will not be entertaining these negotiations while the government is shut down.
Our Congress reporter Caitlin Riley there joining us from Washington with the latest. And of course, as we continue to see this U.S. government shutdown, there are questions about what happens to economic data like the Friday payrolls numbers that we were expecting. And of course, the impact on Federal Reserve thinking and just broader macroeconomic impact. Let's bring in Jeanette Garretty, chief economist at Robertson Stephens. Jeanette, great to have you with us. What are your expectations on not only the direct economic impact coming from federal furloughs, agencies having to shut down, and the indirect impact also on the Fed's thinking, because we're not getting this crucial data?
Yeah, the Fed has other places that they can get similar data. I mean, the most notable one, for example, is today with the ADP numbers that came out and said negative 32,000 jobs. By the way, those numbers do not include federal workers. They never do. They're payroll numbers here in the United States, whereas the BLS data always includes federal workers. That's a sensitive topic right now, all of a sudden. But they have places they can look for the data. I think the shutdown itself, especially given the level of conflict that is emerging this week, today, over this shutdown, probably tilts them towards another cut at the end of October anyway, because there would be worries, and I think there should be worries, about the fact that this shutdown is coming at a time not when the U.S. economy is ramping up, but quite the other way around. There's a lot of evidence that things have been slowing down, even though third quarter economic growth is probably in excess of 3%. So that's likely to make the Fed nervous no matter what about the shutdown. So it's a very fraught situation. It's a great idea that the Fed might cut, but there are real economy consequences that the rate cut can't fix.
We have precedent during President Trump's first term when we had that 5-week shutdown back in 2018. What were the implications for the broader economy then, and how long-lasting were they? Jeanette.
Yes.
Hi. I was just asking whether or not we could take some examples from the shutdown during President Trump's first term back in 2018 when it comes to economic lessons.
We can take some. So that first shutdown, the GDP hit was in the range of about a 0.5 percentage point of GDP in the quarter, and then usually made up in the following quarter. But this sounds different today, depending on how fast the Senate moves to agree to things on their own. this could be very, very different. This could be a situation, if it drags on, then this could be a situation where indeed the White House could proceed with these very dramatic actions that I realize that they are intended to be to move things forward. They're intended to be a bit retaliatory, but there will be an economic impact, and that isn't going to do anybody any good.
Can the Fed move forward? Is there consensus on what it's going to do at its next meeting, especially with the concerns about its independence still an overhang?
Yeah, look, there has been emerging very quietly from the Fed governors and from a number of Fed presidents messages that indicate that, look, we don't have to move very fast. We can continue to take moderate rate cuts, another 25 basis points. And that has set aside for a while some talk that there might be a bigger rate cut at the end of October, 50 basis points. I generally agree that that's the standard view, but if things get really nasty between now and that Fed meeting, and there are dramatic economic consequences as a result, it would be unusual for it to happen that fast, but there's some possibility of it, then we might be looking at a larger rate cut. I don't think so right now, but it's going to come back on the table.
Jeanette, talk to us as well about some of the Trump administration policies and how, since they've been pushed through since April, are the U.S. consumers better or worse off for it? I mean, we keep going back to this debate, right? Why is it taking as long as it is to show up in the economy?
Well, I think it is showing up in the economy, and it's just not showing up perhaps as dramatically as some people thought it would. American businesses are incredibly resilient, and a lot are very flexible in responding to situations like this. And it's been a combination of consumers adjusting their spending behavior, businesses adjusting their operations to try and make this work. I will say that one of the more notable things about the ADP employment report today was that most of the job loss was in small and medium-sized businesses, and it was concentrated in the leisure and hospitality sector. That's very interesting. That's exactly sort of where you might expect job loss to start to occur if it's becoming increasingly difficult to deal with the uncertainty and the cost pressures from tariffs.
Wonder also if you could weigh in on the impact on the long end of the bond market, the Treasuries curve, because we did see those concerns really playing out past couple of months, but that seems to have eased off a fair bit.
It has eased off. If there is a more aggressive rate cut at the end of October and the inflation numbers haven't turned in the right direction, meaning starting to go down, not continuing to be relatively high, I think that's going to be a problem for the long end. Something that has not been brought up, at least in the commentary today that I have seen, that could also end up being a long end is a question about what the rating agencies will do at this point. With the shutdown, with the entrenchment on both sides, if it begins to look like it's going to be a very long, drawn-out, conflicted process, it'll be interesting to see what the commentary will be there, because the rating agencies have been talking about this for some time. We'll see.
And it's also interesting because we could see this as a sort of regular fixture all the way until the midterms, potentially. We shall see. This Democrats and Republicans going toe-to-toe. Jeanette, really great to get your insights. Thank you so much. Jeanette Garretty is Chief Economist at Robertson Stephens. We'll have more ahead on the Asia trade. This is Bloomberg. U.S. drug makers are in focus after Pfizer reached a deal with the White House, easing concerns over aggressive drug pricing policies. The company secured a 3-year reprieve from tariffs by agreeing to reduce what it charges Medicaid and align future drug prices with those in other wealthier nations. For more on pharma tariffs, let's bring in Bloomberg economist Nicole Garretty. So, Nicole, put things in perspective for us as we watch some of these companies carve out agreements with the Trump administration.
Sure. So last week, we had a Truth Social post from President Trump announcing 100% pharmaceutical tariffs. These are a set of tariffs that we knew were coming. There was a Section 232 investigation ongoing that was sort of lining up the administration to announce new tariffs. There was quite a bit of stockpiling of pharmaceutical goods, especially from the European Union earlier in the year. So sort of no surprise that these were on the docket. I think there were a few things in the announcement that were a surprise. It had the sort of shock and awe sense that many of these announcements do, where it came in the evening at 100% tariffs on pharmaceuticals. At first glance, it seemed, I think, like quite a big move, and our estimates taking that number at face value did suggest that this could be quite significant, not just for the pharmaceutical industry, but in terms of the U.S. average tariff rate overall. But then as we kind of dug into the details and a lot more of this unfolded, I think it became a little bit less clear how big of an action this really was. So to give you an example, there's a carve-out for generics, so the tariffs will only apply to branded and patent pharmaceuticals. And then, as you mentioned, there's going to be carve-outs for specific firms, and these could be quite extensive. So at the time of the announcement, part of the plan for the tariffs was that there would be a carve-out for firms building in the U.S. We saw the Pfizer deal that you mentioned, which also seems like some kind of pricing agreement may also allow firms to get some carve-outs. And then today is October 1st, the day that originally the tariffs were set to go into effect. As far as we can tell, they haven't actually gone into effect. And based on comments from Commerce Secretary Howard Lutnick, it seems like the administration is very interested in talking to firms before they really finalize anything.
What about the tariffs on other sectors? We've heard about timber, just furniture, kitchen cabinets as well, at a time when, of course, we continue to watch the U.S. housing market very closely as well when it comes to the Fed's trajectory and how consumers are dealing with prices. Are we going to see any significant impact from all of these other sectoral tariffs?
Yeah, it's a great question. So the one piece that you just mentioned that we do have some clarity on in terms of exactly which products will be affected is the timber and then bathroom or kitchen cabinets, and vanities products. So in total, so these tariffs are set to go into effect October 14th. They're not very high, the level of the rates, and it doesn't affect a huge slew of products. And it was a little bit below our estimates of the full set of products we thought that this Section 232 on timber could apply to. So overall, I think that move is certainly milder in terms of the macroeconomy than the pharmaceutical move. But of course, as you mentioned, for those sectors, for construction, could be quite meaningful. The other set of tariffs that we're on the lookout for, but did not get in this flurry of recent announcements, are semiconductor tariffs. So kind of similar to the pharmaceuticals, we've seen stockpiling of some electronics earlier in the year. We know the administration has said multiple times that these tariffs are imminent, but the details are yet to come out.
Nicole, what about the impact on pharmaceutical prices?
I think it's very hard to say right now because it's not clear how these tariffs are going to be implemented, exactly the bar that firms will have to clear to get some sort of exemption, either based on their manufacturing plans or based on like some kind of deal like Pfizer. I think it's certainly possible that a large share of firms will end up being exempt, in which case there wouldn't be much of an impact on prices. But I think there's still a lot of details to be worked out in the implementation of this, in the which firms will be up for exemptions, et cetera. So at this point, I think looking pretty good for most firms. There's a lot of ways out of this.
Something that Americans will be paying close attention to, given, of course, the ongoing anger already over high drug prices in the United States. Bloomberg economist Nicole Gorton-Caratelli, good to have you with us. These are some of the other corporate stories that we're following at the moment. Sales for Chinese EV maker BYD fell in September for the first time in more than 18 months, even as domestic rivals reported strong gains amid fierce competition. Shipments declined 5.5%, marking BYD's first on-year contraction since February 2024. The company has slashed its sales goal for this year by 16% to 4.6 million units in what it calls a nimble response to a changing market. Bloomberg has learned that Apple's hit pause on a planned overhaul to its Vision Pro headset. It's said to be redirecting its resources toward developing smart glasses to rival products from Meta. Sources say the tech giant had been preparing a cheaper, lighter variant of its headset for release in 2027. ExxonMobil says its planned global job cuts will affect as much as 15% of its Singapore workforce. That will mean around 500 layoffs in the city-state, among the 2,000 jobs it's cutting worldwide as part of a long-term restructuring. Exxon recently started a new refinery unit in Singapore, upgrading so-called residual fuels into higher-value commodities. We have more ahead on the Asia trade. This is Bloomberg.
Former U.S. Treasury Secretary Larry Summers says the government shutdown is all about the future of American healthcare. Speaking exclusively to Bloomberg, Summers urged lawmakers to look past political distractions and focus on the stark choice at hand.
This is about whether we should be scaling back the availability of health insurance for millions of Americans who in the old system used to not have eligibility for coverage, and in the new system do have eligibility for coverage. And people should make their choice about what they think. And I suspect that that will become clearer in the days, perhaps the weeks ahead, and we will see how it all plays out. But people shouldn't be distracted by the budget resolutions and the supermajorities and the 60 votes in the Senate and the appropriations process or any of that. This is a stark question. The government can reopen tomorrow if the President of the United States is prepared to accept the maintenance of Medicaid benefits, is prepared to accept the continuing functioning of the exchanges that have brought health insurance to millions of Americans, most of whom are employed by small businesses who can't really manage to provide health insurance to all their workers.
Former U.S. Treasury Secretary and Wall Street Week contributor Larry Summers. Take a look at how we're setting up for the Asian market opens. Nikkei stocks already at a 3-week low on a stronger Japanese yen, being boosted by uncertainty given the U.S. government shutdown. Also, Sonlin Tankan results coming with Japan's larger manufacturers, improving sentiment for a second straight quarter. You can see U.S. futures not doing much right now, but do keep an eye on those sectors with high exposure to government contracts given the ongoing shutdown. More ahead, this is Bloomberg. Oil seeing a little bit of upside, but only after falling for another session. It was a very choppy trading given that investors continue to weigh the prospects that OPEC Plus could be fast-tracking output hikes in November. Remember, the International Energy Agency has predicted a record surplus next year, and with U.S. oil reserves also rising by almost 1.8 million barrels last week, we continue to see this inventory glut offsetting some of the geopolitical risk premium premium that has sent oil prices higher. In fact, on geopolitics, the Wall Street Journal now reporting that the U.S. is set to provide Ukraine with intelligence for strikes deep inside Russia. The report says Washington is asking NATO to do the same. Let's bring in Bloomberg's Michael Heath. What do we know about this?
Yeah, Shery, it's come out fairly recently that that the US is looking to provide Ukraine with intelligence so that it can strike probably more accurately, really, deep into Russian territory, at refineries, at its energy infrastructure, basically be able to do to Russia what the Kremlin has been doing to Ukraine, which was targeting its energy infrastructure, just making life very difficult for its economy to run and just to keep the country going. And it's a pretty interesting move, and it's obviously an escalation here, especially considering where President Trump himself came from, just 9 months ago. And it sort of again speaks to the idea that Russia sort of may have overplayed its hand in dealing with President Trump, because it looks like he's turning the other way now. And there's talk that the US might deliver Ukraine Tomahawk missiles with very, very long ranges, up to 1,500 kilometres, if not more. And with high precision strikes. And the idea is that if it hits Russia's energy infrastructure, its oil refineries, that sort of thing, it's going to hit the Russian economy. It's going to make it much harder for them to finance the war effort, and basically try and sort of turn the tables on Russia and show that it has more to lose by continuing this war than it would by coming to the negotiating table.
On top of that, the Europeans also seem to be ramping up the pressure. They could be seizing Russian assets, but Moscow also seems to have a plan to deal with that.
Yeah, well, exactly right. I mean, this talk has been going on for a while about giving Ukraine access to Russia's foreign reserves that were seized, frozen basically in 2022 when the invasion began. And there's been a lot of support for doing that, just because to pay for some of the damage that Ukraine suffered and to finance its efforts as well. To make Russia pay for at least what it's done to Ukraine. But it's just the problem of the precedent set there by seizing another country's assets like that. Russia, in turn, I guess, realising that this is more than likely going to happen now. Even though Europe's looking to loan this money out, it's not going to sort of give it away as such. But Russia, in turn, is speeding up the process by which it can either seize assets of foreign companies or other sorts of things whereby basically it can redistribute foreign assets there in retaliation. Now, it's not going to be as much as, obviously, Russia's foreign reserves. They're pretty significant, several $100 million there. Several $100 billion there. But obviously, it is a way of retaliating. So, we'll just have to see how that plays out. It's been talked about for a while.
Mike, before we let you go, just on another geopolitical issue right now, of course, the ongoing war in Gaza, do we have any more indications on whether Hamas will be accepting that 20-point plan?
Yeah, nothing really yet, but there's our reporting has the Arab states, the countries in the region, and particularly those Turkey, Egypt, Qatar that have been very close to Hamas, are really putting the pressure on it to accept this. They say this is the best opportunity to bring this to an end, to end the bloodshed, and to take pressure off themselves. Their own populations are very upset, and after the Israeli airstrike in Qatar, there was a lot of worry that other countries might be targeted too. So the pressure is really being ramped up on Hamas to agree to this. We'll just have to see how it responds, but it would be very difficult for it to resist these three countries. They're pretty important.
Mike, thank you so much for the latest. Bloomberg's Michael Heath. Now, all this does seem to raise the question of the greenback's safe haven role. Of course, we've been seeing the overwhelming concern being about the shutdown and the Fed's trajectory. The dollar has been coming under pressure for a couple of sessions now. Let's bring in Kamakshya Trivedi, Chief FX and Emerging Market Strategist at Goldman Sachs. Really good to have you.
Good morning. It's nice to be here.
So how are you positioning around the shutdown risk in the U.S.?
Yeah, I think it's an important development. I think it's one that has to some extent been anticipated. So it typically tends to not have a huge amount of wall, enhancing impact. But I think one of the narrative that had been gaining ground in the market in the last few weeks has been this sort of trend of U.S. data getting better. And I think the shutdown just arrests that and reverses that to some extent. I think it, brings up the fact that potentially if it lasts longer, you could have some impact on the growth data. You could also have some impact on other metrics in the labor market. And especially when you don't get those sort of official data, if it lasts through a couple of weeks, then there'll be more emphasis on private sector data, other survey data. And so I think what it's done is it's put back a little bit of doubt in the minds of the people who were looking for a U.S. economic recovery. And that in turn has put the dollar on the back foot once again.
So are we looking at new lows on the dollar, you think?
I think what the bigger picture here is that the dollar is still overvalued. It's less overvalued than it was at the start of the year, but that high valuation is gradually eroding with the U.S. being no longer exceptional in a macroeconomic sense or in a market sense. But exactly against what? That keeps shifting, right? And so if it was euro at the start of the year, it was CNY in August, it's been emerging markets over the summer, you're beginning to see the yen finally move as well. And that's quite typical when concerns around U.S. growth come to the fore, when you have both U.S. equities, U.S. rates declining together, a little bit like you've seen in the past few sessions, the yen tends to be the primary beneficiary, and that's what we're seeing in the last couple of days.
Will that be sustained? I mean, the Japanese yen has seen some dead cat bounces in the past where it's really stayed within the range despite, of course, ongoing risks around the world. Could we see it finally break out?
Yeah, I mean, look, I think, breakout is a high bar. But, yeah, I think, we obviously have developments in Japan as well. The uncertainty around the LDP election has been one of the things that have kept investors at bay from really latching on to a kind of constructive yen view. And I think some of that uncertainty being resolved, I think, will also help the yen to make some further progress. So I do expect over the next, few weeks, the yen to move stronger, for dollar yen to come back towards the mid to low 140s. But I think to make further progress beyond that, you do need to see U.S. data weaken more significantly. You do need to see those slowdown risks come back to the fore. We've had a little bit of a flavor of that, a microcosm of that in the last couple of days. If that type of move extends, if that type of fear extends, that tends to be the best environment for the yen. It's the archetypal U.S. recession risk. Those risks are still low, but perhaps have edged higher in the last day or two.
So combine now the fact that we are headed towards the LDP election. We don't know who the prime minister will be and what their fiscal policies will be. Combine that with the Bank of Japan's, your expectations of whether or not they will hike this month. And where are we on the yen, not only in the short term in the next few months, but long term as well, because we haven't seen that haven appeal recently with the risk of moves that we just mentioned.
Yeah, look, I think that, our expectation is that the Bank of Japan will hike in January. So I think they will still be looking for more confirmation from the data, more news from surveys to get confident that, the kind of, wage price dynamic that they are looking to see to get to a kind of sustainable inflation equilibrium is actually playing out. So October is certainly possible. It's certainly, I would say it wouldn't be a huge shock if they went a little bit earlier. But our core expectation is that they wait until January. And I think, especially as you said, you step back and zoom out a little bit. The bigger picture here is Japanese monetary policy is heading in a different direction at the same time as U.S. rates, U.S. real rates look to be coming lower, right? And so when you kind of zoom out and think about that, we do think the yen has some tailwinds here that should play out, if not immediately in the next coming week, but certainly in the weeks and the months. But to really move the yen, yen a lot stronger. I think you do need to see, as I said, a kind of more convincing deterioration in U.S. data. That's not, our broader core forecast for the U.S. is still, a period of softness, but then as you go into 2026, you do see some recovery. So I think there's a kind of, push and pull here. There's the relative monetary policy expectations, certainly a yen support, and I think should become clearer as we go through the year and into next year. But on the U.S. economic side, actually things might be looking a little bit better as we move into 2026.
Yeah, it's been really interesting to see how range-bound the yen has been. But what's caught my eye recently, the BIS now saying that the yuan is moving closer to replacing the pound as the fourth most traded currency. Of course, China away on holidays right now. But when it comes to expectations of the yuan in terms of course, anchor currency for emerging market currencies as well, where are we seeing this going given the ongoing economic issues there too?
Yes, I think there's obviously that kind of structural dynamic that you mentioned. China's role in the global, trade share has been growing for some years, and I would say arguably decades. And, alongside that, its role in some of global trade invoicing, some of those metrics that you mentioned, is also gradually increasing. But, that shift is likely to happen on a much more tectonic scale. This is going to be a long-term move. I think in the near term, though, we are actually quite constructive on the Chinese yuan. We think that you could see a move down towards the 700 level by the end of the year and a push below that towards 690 as you move into next year. And that is less about the broader CNY internationalization dynamic that has been at play and I think will remain at play over many years, but it's going to be a slow process. It's going to be a very gradual process. But it is more about the fact that China's external balances, its trade performance is really remarkable. And it comes at a time when the currency in a real effective exchange rate basis is very, very undervalued. So I do think Chinese policymakers will allow a significant appreciation of the CNY, but that's going to happen on a steady, consistent basis rather than a quick one-off move.
The subtext to this also does seem to be the rethink that we've been seeing on the dollar this year, because it's not just the yuan, the rupee also. We've seen developments this week about internationalization of that. How do you see that progressing?
I see these things progressing on a very, very slow basis. I mean, I think that dollar dominance, can erode on the margin, but there are many things still going for dollar to remain an important currency and retain its role in the international monetary and financial system. I don't think that dollar dominance is ending anytime soon. That does not mean, however, that the dollar cannot depreciate. We do expect the dollar to depreciate, but that is based on the view that the U.S. macroeconomic performance, U.S. market performance just looks a bit less exceptional than it used to, and it does not warrant the high valuation that it used to have. But I think the idea that the dollar is no longer going to play a dominant role in the global financial system, I don't think that's going to come to pass anytime soon. I think it's going to be a very gradual process by which some of these other currencies, slowly try to take on a bigger share. But I still think the dollar will remain dominant.
We've also been watching the won because of these potential direct investments into the U.S. Do you see that coming to pass, and how might that weaken the local currency?
I think there's a lot of uncertainty around that. I mean, both around the actual negotiation, the actual amounts involved, the timeline for when these things happen. And then, bear in mind, I mean, one of the things that also matters is, how anticipated they are, how well telegraphed they are. So as of now, we're not making any sort of big judgments on the currency based on this. I mean, it's very hard until you have the details, the timelines, the concrete, measures that are likely to be taken place. Whether this money is, going to be raised in international markets, it's going to be directly sourced from domestic markets. There's a lot of unknowns here. So as of now, it's an important thing to watch. I'm not sure it should be the foremost thing driving the won.
Kamakshya, really great to chat and great to have you in Singapore as well. Thank you for your analysis. Kamakshya Trivedi is Chief FX and Emerging Market Strategist at Goldman Sachs. We'll have more ahead on the Asia trade. This is Bloomberg.
We'll be watching Samsung and SK Hynix when markets open in Seoul. Both stocks have already outperformed the Philadelphia Semiconductor Index this year, and they could pull further ahead on agreements to supply chips and other gear to OpenAI's Stargate project. For more, let's bring in Bloomberg Intelligence Technology Senior Analyst Masahiro Wakasugi. Masahiro, so we are talking about 900,000 wafers per month. How significant is this?
So, yes, maybe, 900,000 wafer per month capacity is a pretty big number. So, if we, calculate Samsung's current existing whole capacity for DRAM should be around 700,000, or could be 750. And in terms of SK Hynix, I think the number could be something like 400-something thousand wafer start per month. So 900 number itself is quite a big number. Maybe the 900 includes all conventional DRAM and also HBM as well. But maybe eventually, if the OpenGate project, OpenAI Stargate project requires that kind of capacity for DRAM, that could be the quite significant impact on the overall DRAM industry as well. Yeah.
This is also coming amid the resurgence in NAND. Overall, what do you see as the headwinds, or I should say tailwinds, for SK Hynix and Samsung?
Yes, I think that in this story, I think that both Samsung and also SK Hynix could be benefiting from this AI shift. And maybe this story is only talking about maybe HBM or probably AI-related DRAM. But also we think that probably maybe NAND flash memory could be benefiting from the overall data expansion story. So I think that maybe going forward, competition could be a bit getting tougher and tougher. But if we think that demand will be emerging something like 900K, 900,000 capacity per month going forward, suppliers can easily make a plan to expand the capacity to avoid the oversupply situation. So maybe the transparency could be good for suppliers and in terms of the visibility, I think.
Who ends up benefiting most here between Samsung and SK Hynix, given that they're rivals in the Korea market? And we have seen so far Samsung pretty much lagging SK Hynix in these advanced chips. So
we don't know if the Samsung could be successful in the next generation HBM, but I think that so far SK Hynix really enjoyed the market expansion already. So if Samsung can catch up with the race, probably the impact could be larger for Samsung Electronics, I think.
Masahiro Wakasugi, great to have you with us. Bloomberg Intelligence Technology Senior Analyst here with the latest on, of course, those supplies coming from SK Hynix and Samsung when it comes to advanced chips, and those very crucial when it comes to new technologies. And we'll be focusing on humanoid robots because now they're beginning to move from demonstration into selective use in auto and factory settings where traditional automation has struggled in the past. Bloomberg Intelligence says humanoids might take on up to a quarter of auto material handling by 2035, with the overall humanoid market growing to up to $5 billion by that year. Senior industrials analyst Takeshi Kitaura joins us now with their latest industry outlook. And this is a very interesting report on humanoids, but why focused on the auto sector?
So there's, I think for humanoid robots, a lot of the companies developing it, like Tesla or Boston Dynamics under Hyundai, are related to auto firms. So they actually have a testing ground to test these technologies as they develop. So auto assembly plants are areas that initially going to uptake these robots for testing. So we focused on how realistic these task replacements are for humanoids.
What about the addressable market? Because I think some estimates are for $5 billion by 2035. How does this compare with some of the other numbers out there?
Yeah, so thank you. So $5 billion is, to clarify, it includes parts and also peripheral parts, also integration as well. And this is only for the auto assembly usage. So if you take a broader view, it'll be larger. I think the market outlook for the whole space of humanoids could be higher in a lot of the market estimates, but we took a realistic approach because auto assembly is the initial phase where these will be tested going forward. There is, however, some hurdles to overcome, which could be the battery length for the operations, the dexterity and efficiency compared to human labor, and of course the cost.
Tell us a little bit about all of those challenges, given that, of course, scaling is an issue right now, adoption and then rollout.
So I think taking it from a battery perspective, a lot of the humanoids currently out in the market maybe has like 2 to 4 hours of operation, which means if you wanted to work a full auto assembly shift of 8-9 hours, you need 2. Or exchange batteries, but at the same time it goes to the second argument of is the additional battery cost in line with replacing workers, which could be efficient as well. And currently the tasks of material handling are relatively easier for humanoids to handle initially, but whether they can do it as fast as a human worker is also important in actually getting these humanoids from testing to actual usage.
Especially when you see those boxing humanoids that can't actually run properly. But we'll continue to watch the space. Takeshi Kitaura, Bloomberg Intelligence Senior Industrials Analyst, with his latest report on this segment. So do go read that. But also, you can learn more about the future of humanoids on Bloomberg Tech Asia. Check out our latest episodes and more from our tech coverage on YouTube. Our next live episode is coming up later this month. This is Bloomberg.
The data dogs are howling because we're not getting our usual supply of information. I will say, I consider the Bureau of Labor Statistics job data to be the absolutely best data source on jobs and statistics in the entire world. If we aren't going to have those, it's problematic. That said, the Chicago Fed has come out with some new job market indicators, and we'll be releasing them tomorrow.
Chicago Fed President Austin Goolsbee there talking about the uncertainty from the U.S. government shutdown, which of course has already sent the Japanese yen higher. We're talking about breaking that 147 against the U.S. dollar at one point. We also had solid business sentiment to add to that, really leading to maybe expectations that the BOJ will hike rates, and the 10-year yield already at the highest since 2008. Do watch out for the 10-year auction. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens and the reaction as the U.S. dollar continues to weaken, the longest losing streak in a month. As Avril, we just saw the first U.S. government shutdown in nearly 7 years.
Yeah, and then that raises the question, the dollar declines, are these structural, are these cyclical? Suddenly we're seeing on the other side of the trade how that's playing out on the Japanese yen. So that's something we're going to be watching in the session as well, Shery.
Yeah, which at one point broke that 147 level against the greenback. We continue to see that pressure on Japanese stocks given the strength of the Japanese yen. 4 sessions of losses already, and we're headed towards that market opens on a day when we also have a 10-year JGB auction. And remember, given, of course, the solid Tankan results that we got, confidence among Japan's large manufacturers improving for a second straight quarter, now there are investors thinking that we could see another rate hike this month. The 10-year yield has been hovering near the highest since 2008. So we'll continue to watch if there's investor appetite, especially at a time when the Japanese yen has now strengthened on the U.S. shutdown uncertainty as well. We're at that 147 level. Take a look at how the Kospi is also coming online, because we saw a little bit of a boost given that the Korean won has weakened on this risk-off sentiment. Not to mention the trade data has been a little bit weak with shipments falling in the last export numbers. Now we got the trade trade surplus as well narrowing in the month of September. We got the current account surplus also narrowing. And given the domestic demand picture, we were expecting inflation to be a little bit pressured. We saw consumer prices climbing 2.1% in September from a year earlier. This is an acceleration, but it's also because we had some idiosyncratic news around government subsidies, not to mention also some mobile bill changes. But at the moment, you can see the cost be gaining 2% because we're also watching two stocks very closely, Samsung and SK Hynix. They just inked a deal to supply gear to OpenAI's Stargate project.
Take a look at the Australian Open as well, Shery, as Australia stocks, they look pretty flat past couple of sessions, but they are also pulling ahead like their counterparts in South Korea. Materials and health stocks are doing pretty well today. And we're also seeing, right, not just about the dollar, when you look at Treasury yields, following on from that weak jobs numbers, ADPs, the path of least resistance, something we've been talking about for this week, is lower Treasury yields. We're seeing the 10-year at that 409 level. Let's bring in Peter Kim, investment strategist and head of the Global Business Group at KB Securities. Peter, great to have you. Let's start with stocks because they continue shrugging off these shutdown risks. But to what extent is this going to continue, given how we could see Democrats, Republicans, their disagreements becoming even more intense and a regular fixture all the way until the midterms next year?
That's the biggest question that everyone's asking. I think the current animal spirits within stock markets, not just in the U.S. but globally, is almost messaging that investors are seeing through this brinkmanship that's going on in the U.S. I think we've, for years, analyzed the negotiation strategies of Mr. Trump and his administration, which is essentially take yourself to the edge of the cliff, try to squeeze out as much concession from the counterparty as possible, and then pull back. And I think that's what the equity market is signaling, and hopefully that's how it'll end. But obviously, every week we see old rules being broken, and I think we cannot deny that we're seeing something entirely new here. So I think a little warning would be not to lean on what's happened in the recent past too much, but obviously we all hope that this will be resolved in the near future.
So prompting some caution perhaps, does this include in these high-flying tech stocks?
So when I was here last time, just the day after the Liberation Day in April, I was very bullish on China, in particularly Chinese tech. I think tech stocks continue to defy gravity. I think it perfectly designed for that animal spirits where valuations don't matter, but the concepts, the growth prospects and the future supersedes these rising risks geopolitically and other type of a policy risk. And I tend to think that when you have animal spirits this strong with liquidity still ready to pounce, should there be any slowdown in the economy, is probably the way to go.
So let's talk a little bit more about those tech stocks, because we're getting Samsung rising, and we're getting SK Hynix gaining more than 8%. And now we had news about that deal with OpenAI to supply them gear for the Stargate project. What about valuations in these Asian companies? We've talked about the Magnificent Seven. We've talked about the AI tech companies over in the U.S., but we have also hardware companies that supply to this sector. How are we looking?
Looking great. I mean, valuations relatively for overall emerging market is cheaper relative to the U.S. We are a laggard for many years now, and with the a lot of growing sentiment that the dollar is in a structural decline, even if it's a cyclical decline, it augurs well for emerging market equities. Again, in particular, the tech stocks. So I think from now till the end of the year at least, I don't see significant headwinds against Asian tech, possibly extending into next year.
Is it a story that lifts all boats, or is it just sectoral? Because at the same time, we continue to get data from South Korea that the trade surplus is narrowing. Of course, we have the impact of tariffs. And of course, we have the ongoing tensions between China and the U.S. as well.
For South Korea, it's a very good proxy or indicator for overall emerging markets. As you say yourself, the narrowing trade surplus is a concern. But again, we are in a world where going into next year, how will the inflation outlook look? I do believe that each country now will probably see different types of inflation, and the path is going to be quite different, where the no longer U.S. will just lead that inflation and interest rate path, and for the rest of the world to follow. Another point that I want to make on Asia is that the U.S.-China talks is still yet to be resolved, and perhaps it may not be resolved for the rest of this Trump administration term. So there's a lot of uncertainty, and I do think that we have to be very cautious about how that trade talks will play out.
And perhaps adding on to that as well, when you look at Korean stocks overall, it's dependent on some of these deliveries and policy pledges from the government at a time when they are engaging with the U.S. on tariffs, on direct investments. Do you see that as a layer of a distraction, or how do you square that away?
Yeah, well, so, it's very easy to forget, given the strength of the South Korean stock market, that the GDP is going to below 1% this year. Next year, they're going to struggle to go for anything about 1.5. So I think the stock market is telling a very different story. For South Korea, any GDP growth of less than 1.5 is essentially a recession. So I think to square the divergence is that we need to continue to push this market reform. The policy needs to continue its momentum. So far, the investors embraced it, but investor sentiment could turn very quickly. So I think it's important that the South Korean policymakers maintain the commitment to market reform, because the underlying economy is not going to support the current exuberance.
Beyond Korea, we have seen broader emerging markets also being supported by the fact that the U.S. dollar continues to weaken. Is this going to be sustained, the losses ahead, given the Fed's trajectory, or could we expect some upside?
So I'm in the camp that the U.S. dollar is going through a cyclical weakening rather than a structural one. Talking to almost 100 investors over the past 6 months, it seems to be clear to me that there is more of a political desire to see U.S. assets decline as a result of the Trump policies, rather than purely looking at it on fundamental terms. So there is a political desire to prove that the current Trump policy is going to really bring down the standing of the U.S. as a nation and its financial market. So I'm a little bit cautious about the call for this structural decline. Cyclical one, I mean, in itself should, again, augur well for emerging market equities. But we should really be cautious about how all of this plays out in the next 12 months.
Peter Kim, good to have you with us, head of Global Business Group at KB Securities. We continue to watch that rally in Asian chips. And of course, we talked about that investment between Samsung and SK Hynix to supply gear to OpenAI Stargate project. We're talking about 900,000 wafers per month as Stargate continues to expand. And that would be more than double the current global capacity for HBM. And you can see the broad upside, especially for SK Hynix, more than 8%. Advantest here in Japan, Tokyo election also gaining more than 5%. And do keep an eye on SoftBank as well, because they're also investing in Stargate. More ahead. This is Bloomberg.
I actually don't think it's going to be that long of a shutdown. This is a pure guess from the Vice President of the United States, because I think you already saw some evidence that moderate Democrats are cracking a little bit. They understand the fundamental illogic of this.
U.S. Vice President J.D. Vance on the federal government shutdown. For more on that shutdown, let's bring in our Congress reporter, Caitlin Riley, in Washington for us. Caitlin, what is the state of play at the moment? Is there a way out of the shutdown? Is there a path to this? If so, what might that be?
There's not a clear pathway right now. There are no votes scheduled in the Senate tomorrow, so we know this will be going on for at least a few more days. Right now, Republicans are staying firm on their position that they will not negotiate with Democrats on their demand while the government is shut down. Those negotiations on Democrats' policy demands will have to wait until the government is open, Republicans are saying. Still, we are seeing some indications of rank and file Democrat and Republican senators starting to talk to each other about areas where they might find common ground. No agreements have been forthcoming, and leadership has stayed on its position that it will not negotiate while the government is closed. And so that's where things stand today. We will be closed for the next few days and potentially beyond that.
What are the nuances behind what Democrats are asking for and how Republicans have responded?
Yes, so Democrats are asking for Republicans to roll back about $1 trillion in cuts to Medicaid that Republicans passed earlier this year. That's part of Republicans' signature legislative achievement so far this administration. Democrats also want an extension to Obamacare subsidies that they enacted during the pandemic that bring down healthcare premium costs for low and middle income households. Those are due to expire at the end of this year, which will cause premiums to spike. Democrats are insisting to a permanent extension to those subsidies as part of a deal to reopen the government. Republicans have shown some willingness to discuss extending those subsidies, but the position is not until the government is open once again.
Our Congress reporter Caitlin Riley there joining us from Washington on the latest negotiations when it comes to the U.S. government shutdown. We're also watching talks outside of Washington and between the U.S. and China. Soybeans look set to be high on the agenda for upcoming talks between President Trump and China's leader Xi Jinping. American farmers are increasingly worried their crops will go unpurchased this year without a trade deal with Beijing. Our chief North Asia correspondent Stephen Engel is in Hong Kong. Steve, what do we know about this?
Well, we do know that Donald Trump is becoming increasingly concerned by the unrest, if you will, by U.S. farmers, because keep in mind, traditionally in the past decade or so, anywhere between 28 to upwards of 60% of U.S. soybean crops, which is underway, by the way, the harvest is underway right now, go to China. This year, a big zero. They've halted purchases this year, and about a fifth of the crop has already been harvested for what has been projected to be about 117 million metric ton total harvest, and China has not bought any yet. And again, China has diversified its sourcing from places like Argentina and Brazil. And as you can see there, flatlining essentially the purchasing of U.S. soybeans by China. Again, we can change to chart 2 and see without a deal, American growers from the Midwest, Minnesota, Ohio, Nebraska, all the way out to the West Coast in the eastern part of Washington state. They are facing the gloomy prospect of overflowing storage bins as well as sinking prices. And that's where we can go to the third chart and look at soybean prices. Yes, after Donald Trump said soybeans will be a major topic of discussion and essentially hinted that China is just using this freeze on buying as a negotiating tactic and that they will get to to the bottom of it and have some sort of agreement with China when he and Xi meet on the sidelines of APEC in about 4 weeks' time. But again, soybean prices overnight, the futures did come up a little bit. But again, we're coming out of a 2-year slump, the worst slump in 2 years, in 10 years, I should say, in a decade for 2-year prices of soybean futures. So again, if this freeze continues and China does not buy or resume purchases when we're already a fifth through the harvest, it is going to be, pretty much bad signals for the U.S. farmers. And that is something that is politically sensitive to someone like Donald Trump. Many Midwest farmers, it's presumed, are Trump supporters.
Yeah, you might see some backlash on the Trump administration. But on that point about this allegedly being a negotiating tactic by China, what does a potential U.S.-China agreement even look like?
Yeah, well, we do know that in the trade deal in his first term, Donald Trump's first term, soybeans were a key part of that and China's pledges to buy it. Of course, that unraveled fairly quickly because of other geopolitical, difficulties as well as the pandemic. So soybeans will be part of any kind of negotiations. As Donald Trump says, he's going to put it up high on the agenda, major topic of discussion. But just in the last day or so, we heard from Republican lawmakers, they say China will not be resuming purchases of American agricultural products anytime soon. That was their conclusion after having a closed-door meeting with the U.S. Ambassador, David Perdue, who I guess gave the on-the-ground report that China is not showing any appetite right now. Or at least, I should say, they're not playing their cards. There's still a month now between, before that meeting between Xi Jinping and Donald Trump. Now, if soybeans are a major negotiating tool and tactic by the Chinese, they're not going to tell the Americans they're willing to negotiate on that matter. So, again, we'll have to kind of wait and see. But for American farmers, they have to wait another month before they get any clarity. In the meantime, Donald Trump has indicated that the U.S. government is willing to maybe use some of the tariff revenue from China and elsewhere to give financial aid to these farmers. But again, what we're hearing from the farmers in the Midwest and in the agricultural areas of America is they far prefer a trade deal with China than receiving handouts from the U.S. government.
Steve, thanks so much for talking us through these developments. Chief North Asia correspondent Stephen Engel. Now, here are some of the top global headlines we're following. The U.S. will reportedly provide Ukraine with intelligence for long-range missile strikes on Russia's energy infrastructure. The Wall Street Journal cites unnamed U.S. officials saying the Trump administration is also weighing sending Kyiv powerful weapons that could put more targets within Russia in range. The report also says U.S. officials are asking NATO allies to provide similar support. Russia is said to be planning to nationalize and quickly sell off foreign-owned assets under a new fast-track privatization order signed by President Vladimir Putin. The move comes as EU leaders push a $164 billion loan plan for Ukraine using frozen Russian central bank assets. A source says the decree aims to accelerate Moscow's reshaping of its corporate landscape. Bloomberg has learned that Brazil and the U.S. are working to arrange an in-person meeting between their presidents. Multiple Brazilian officials tell us that the government views this month's ASEAN summit in Malaysia as an ideal venue. A meeting with Trump is said to be a top priority for Lula, though the Brazilian leader wants to ensure he has sufficient data before the one-on-one, Shery.
Avril, take a look at how European futures are trading after stocks rose to record highs in the overnight session. We saw drug makers leading those gains, just as we did in the U.S. session after Pfizer struck that deal with the Trump administration to sell drugs directly to consumers at cheaper prices in return for a tariff reprieve. We also saw steel stocks boosted by an EU plan to restrict foreign imports. You can see stocks 50 futures up 0.3%. The euro not really doing much. It didn't do anything on the overnight session. Euro area inflation accelerating in September again. We have more ahead. This is Bloomberg. take a look at the rally in Asian chips. We're seeing the best day for SK Hynix since April, and also Samsung Electronics at a record high. These two companies just inked a deal to supply gear to OpenAI's Stargate project, and we're seeing also the sympathy gains in Japanese chip stocks as well. For more, let's bring in Bloomberg Intelligence senior technology analyst Masahiro Wakasugi. So we're hearing about 900,000 wafers per month. How significant is this for Samsung and SK Hynix?
Yes, 900,000 wafer per month demand, potential demand looks quite a huge number. So when we calculate the current Samsung's DRAM capacity at this point, it would be something around 700 or 750,000 wafer starts per month. And when it comes to SK Hynix, the number should be 400 or 450,000 wafer starts per month. So 900 could be the overall demand for the new Stargate project, but maybe the potential demand should be quite huge for the DRAM suppliers, I think.
Might this change the competitive landscape in DRAM or the high bandwidth memory market?
Yes, in this case, the interesting point would be the, Samsung could be the front of the news story, and so far SK Hynix was the major supplier of the HBM chips, and that strength will continue going forward. But if we look at the overall demand, we may need another supplier, and also Micron is already a big supplier for HBM. But going forward, if the AI demand continues to expand, in that case we need one more major supplier. That could be the Samsung, could be the potential HBM supplier going forward for the most advanced NVIDIA related GPUs. So probably I think that there may be some competition going forward, but demand is so strong that maybe we don't see very significant pricing competition going forward. Rather than that, we will see the healthy demand increase could be possible for the HBM market.
We heard that Samsung Group companies could also try to work with OpenAI, Samsung SDS, Samsung CNT. Is this really the game changer? Could it be?
Could be, yes, because when we talk about the data center project, the power consumption or maybe the building the whole infrastructure could be quite a big, a big problem going forward. So maybe labor issues or energy issues. So we have to address all problems about the data center build out going forward. So in that case, Samsung Group as a whole, maybe they can collaborate each other. So that could be the strength for the Samsung Group, I think.
Masahiro Wakasugi, really good to have you back. Bloomberg Intelligence Technology senior analyst, as we continue to watch Samsung Electronics trading at a record high, which has sent the Kospi also to a new record high. SK Hynix also seeing its best day since April. More ahead on the Asia trade. This is Bloomberg.
Let's take a look at how Asia benchmarks are faring after U.S. stocks shrugged off the risk from the U.S. shutdown. We, of course, saw global stocks hitting those all-time highs. Good day to be an Asia stock investor, especially if you're in the AI space. That Kospi benchmark being lifted by the likes of Samsung and SK Hynix. You're also seeing the AI play on the Japanese benchmark. And this is despite some expectations that things are coalescing around a potential hike from the BOJ, and that's impacting the yen. Now, we are also watching EV makers because the EV giant BYD's monthly sales fell in September for the first time in more than 18 months. This is even as domestic rivals reported strong gains amid fierce competition. Our China correspondent Min Lo joins us for more on this. So, Min, this looks like a pretty bad report card for BYD.
Yes, it seems like a turning point for BYD in some ways because its vehicle sales in September was down by 5.5% on year. It was actually improving on month, but on year it's a decline, and it's the first decline in about 1.5 years. And if you remove the seasonal fluctuations from Lunar New Year, it's actually the first decline since 2020 when COVID hit and disrupted supply chain. And it shows you that the intense competition is there for BYD, especially with the price competition going on in China, even with the anti-involution campaign that is in place. And it's particularly stark, especially when you compare to some of the rivals like Leapmotor or other brands that are looking at over 90% gains in their vehicle sales in September. Even Geely looking at 35% gain. And that is a company that is undergoing some sort of restructuring as it tries to better compete with BYD. It's in the process of withdrawing the Zeekr brand from the New York Stock Exchange. And granted, you can see here on the chart, very different results here for BYD versus some of its other peers. And some are saying that, yes, maybe you can't compare them like for like because BYD is in a different stage of development. The others are obviously coming off a smaller or a lower base in the previous year, but still it shows you that even the biggest player is also affected by the intense competition at home.
I mean, how about Tesla sales in the third quarter?
Tesla sales in the third quarter, the actual results are not out, but forecast is out and estimates are that it will fall by 5%, which is bad, but is better than the first half at least, which was down by 13%. The question is whether this trajectory of its recovery is going to sustain in momentum because the third quarter benefited from tailwinds because of that tax credit, the federal government tax credit, $7,500, that has expired in September. So that really fueled this summer rush to buy EVs in the past few months. And that means without that credit in the fourth quarter, the question is whether or not Tesla can maintain that momentum. And of course, there are other headwinds as well, including policy changes with President Trump unwinding some of those regulatory rules when it comes to emission standards that could put Tesla's profits could threaten its profits because Tesla has been making a big business out of selling those regulatory credits to other rivals who can't meet those pollution standards. And so Tesla, so far, it has been trying to shift focus away from its sales slump towards its AI development, including its robo-taxis, for instance. And Wall Street has been lapping that out. We can see the share prices this year, the performance in the past month, it was soaring by about 40% or so, and that helped to recoup some of the losses earlier in the year.
Right, Bloomberg's China correspondent Min Lo there. We're headed towards a Hong Kong resumption of trading in just under an hour. Mainland markets still on break. Let's bring in our Asia equities reporter, Winnie Su. Winnie, what can we expect in today's trading session, especially given that we saw some upside on U.S. traded ADRs?
Right. So overall, the macro picture is still quite favorable, especially with U.S. stocks up, driven by the chip stocks. And also you mentioned Golden Dragon also up. But also we're just expecting a bit more quietness when it comes to the Hong Kong trading today, especially with China on holiday right now. So this also is coming after HSCI rose over 2% in the past two sessions. So you see that a lot of expectations are already being priced in before we headed into this long holiday. And also, historically speaking, we do see some weakness when it comes to the trading in Hong Kong during the China holiday because we don't have that strong southbound inflow during that time. However, last year was kind of a exception, especially when we had that September big stimulus. But just from the historical perspective, we are expecting a bit of lower momentum here in Hong Kong today.
So what are the specific sectors you'll be watching? I mean, Min just talked us through BYD numbers.
Right. So definitely EV sector is top on the list. Yes, we've got that disappointing numbers from BYD, but also their peers actually have shown some quite upbeat sales numbers. So likely we will see a divergence in the EV sector performance here. But also another key sector we're watching here is the Macau casino sector. And that's after the gaming numbers came just up 6% in September. And that has missed analyst expectation of 9%, most likely due to that slowdown after the summer break. But we are really having our eyes on the next set of data because analysts are now expecting quite a pickup and a boom in the gaming revenue because of that momentum during this holiday. So expecting more tourism in Macau. Another one that we're definitely still watching is Alibaba, that big stock we're watching every day. But the newest catalyst that we have here is with JP Morgan raising its price target, talking about the more upbeat outlook when it comes to the cloud revenue and also the synergy between AI and e-commerce.
So, Winnie, as you mentioned, mainland markets are away on holidays until October 9th. But broadly speaking, when it comes to Chinese assets and its overall performance vis-a-vis Asia, perhaps, what are the expectations right now?
So it seems like the overall sentiment is still quite strong when it comes to the Chinese market. Just the latest survey we did with our fund managers, they are expecting Chinese stocks to outperform rest of Asia when it comes to the fourth quarter expectation. And they were talking about that AI tech optimism and also how Chinese stocks has still been that big underweight when it comes to the global investors fund portfolio management. And a few key catalysts that we're watching here for October, one of it being the fourth platinum. So that's going to give more clarity when it comes to the 15th five-year plan. So with that, focusing more on AI about like new EV and consumption, lots of expectation there as well. So overall, quite some excitement when it comes to the upside for the Chinese stocks among global investors.
And we'll watch the Open at Hong Kong today. Winnie, good stuff. Thanks so much, Asia Equities reporter Winnie Su for us. We'll have more ahead on the Asia trade. This is Bloomberg.
We continue to see upside in the crypto space. We had seen gains coming from the uncertainty around the U.S. government shutdown, not to mention that we have a weaker U.S. dollar, the longest stretch of losses in about a month. And you can see Bitcoin now at that 118,000 level. And we usually see some seasonal strength in the month of October. For the last 10 times in the past 12 years, we actually saw gains in October, not to mention that the fourth quarter is also pretty strong when it comes to the season for this asset class. Let's get more on the crypto markets with Shan, Aggarwal, Chief Business Officer at Coinbase, the biggest crypto exchange in the U.S. He joins us from Token 2049 Singapore, which is Asia's flagship digital asset conference. Shan, great to have you with us. Given the backdrop on the cryptocurrency outlook and the ongoing, of course, gains that we're seeing in the market, how does all of this factor into your business plans, especially when it comes to perhaps expansion overseas? You're in Asia right now.
Yeah, thanks so much for having me. We are very excited about the momentum in the crypto space, and we've always viewed Coinbase to be a global platform. We were obviously founded in the U.S., but we're early to move internationally, and I think Token really represents a lot of the momentum in Asia, and it's great to see the excitement here. But we're excited to double down and really invest in our business here in Singapore, Australia, and then very recently we announced our expansion into India as well.
Can you give us a picture of your U.S. business in terms of profits and, of course, also how that mix works with what you're expecting to do in Asia and if there's a target as well?
Yeah, our business primarily consists of two revenue streams. We generate transaction revenue from trading activity, whether that's through trading spot assets like Bitcoin and Ethereum, or futures, and very recently we added options through the acquisition of Deribit, which is the world's largest crypto options exchange. That's the predominant source of our revenue and profits. And then increasingly we've been investing in what we call subscription and services revenue. These are more sticky sticky recurring revenue streams that include things like interest income from stablecoins, custodial service fees, staking revenue, and others. And we expect a roughly similar split between the US and Asia, as a lot of our core features and functionality are global in nature.
What about for inorganic growth? What are the top 5 markets in your mind, Shan?
Yeah, when we think about international expansion, both organic and inorganic, our top-level goal is that we want to bring 1 billion users on-chain and provide that bridge from the traditional financial world into the crypto financial world. And the reason for that is we believe that blockchains enable better, more efficient, and global financial services and a financial system. And so, like I mentioned, we recently announced the launch of our business in India. We also were recently licensed in Argentina. And so we're looking for markets that we feel like can really catapult us towards reaching that goal of getting 1 billion users on-chain.
So India, Argentina, where else would you say are other possible target areas?
Both for an inorganic and organic perspective, we're looking at expanding our business in countries like I mentioned, India and Argentina, but then also growing our existing businesses in Singapore, Australia, and across the EU.
You mentioned Deribit earlier,
2 revenue streams.
Almost $3 billion deal. Go ahead, Shery.
No, because Shan, you mentioned those 2 revenue streams. I was wondering if there's a preference on where you really want to strengthen those gains.
Yeah, we really want to see a mix shift. So, when Coinbase went public, the vast majority of our revenue, over 90%, was from transaction revenue, which is great, especially during periods of high volatility and activity. Like you mentioned, in Q4, we historically have seen high demand and activity in the crypto markets, but it can be volatile. And so over time, we have diversified those revenue streams and supplemented them with more stable and recurring subscription and services revenue. And I think for us looking forward, we want to maintain a healthy balance of the two so that we have a steady base to cover our costs. And, we've committed Coinbase to be a profitable company on an adjusted EBITDA basis across both up markets and down markets, but then also benefit from the volatility that we naturally will see in the crypto space, which can be a huge benefit to the business as well.
There's also a proposed native token for Base. What would the use case for this be?
Yeah, we recently announced that we are exploring a network token for Base, and I'm really excited about this because, from day one, our plan with Base was to incubate it, but to progressively decentralize the network so that it is truly open and decentralized. And I think that this could be a really great step on that path. We're super early in terms of exploring this, and so we're just in the very early days and really looking to get feedback from our community, our users, our developers on what they would like to see before we are prescriptive about any specific use cases for the actual token.
Would you be able to give us ballpark figures on how big the fully diluted valuation in dollar terms might be?
We don't have any preliminary guidance on valuation or terms at this point, no.
Right. Shan, we are also watching out for the crypto industry in terms of regulatory clarity. A lot of headway has already been made this year, but given the U.S. shutdown, to what extent might this derail the progress?
Yeah, we have seen a tremendous amount of momentum in the U.S. on the regulatory front. I think the hallmark or sort of the big milestone from earlier this year was the passage of the Genius Act, which formally set out a regulatory framework for stablecoins in the U.S. And I think despite any partisan disagreements around government funding, we continue to see tremendous momentum behind the scenes where both parties are working collaboratively and in earnest towards what we believe will be a really, really critical piece of legislation for the crypto industry, both in the U.S. and abroad, that covers the market structure for crypto assets and determines how various crypto assets will be classified in terms of being securities, commodities, or otherwise, as well as the appropriate regulatory bodies. So I think despite any of the recent tensions around government funding, that momentum and those conversations have continued on strongly because crypto is truly a bipartisan issue at this point.
Yeah, I was going to ask if you are seeing any impact or expecting any impact from the U.S. government shutdown, and whether you have seen also that shift in tone and narrative coming from the new Trump administration and its sort of more supportive stance when it comes to the crypto markets.
We've certainly seen a more supportive stance, I think, over the last year since President Trump was elected into office. And I think that has trickled down all the way from the executive office to the various regulatory bodies that are relevant to covering crypto. And so just in the last year, we've made a tremendous amount of progress. And I think you're starting to see the industry now go from a stance that historically has been very defensive and closed because, we were living under this environment where there was a fear of regulation by enforcement to one that's really pushing forward on new product innovation. And I think that's creating a lot of excitement from institutional customers, retail customers, et cetera, around trends like stablecoins and tokenization and the like.
Yeah, and what role do you think central banks will play in all of this as well?
Yeah, we see the banks playing a critical role. Fundamentally, we think about blockchains as an upgrade to the existing financial system, not a replacement in any way. We think about the magic of blockchains as effectively bringing internet scale to financial assets. So improved portability and accessibility of these assets globally. So, fundamentally, I think a lot of banks are learning and adapting their businesses to this new technology, and they're seeing a lot of tremendous efficiency gains in terms of how they manage various financial transactions.
Shan, we'll leave it there. All the best for the event. Great to chat. Thank you so much. Shan Aggarwal is Chief Business Officer of Coinbase. And we have much more lined up for you from Token 2049. Dragonfly Managing Partner Hasib Qureshi joins us exclusively on The China Show. And later on Insight, Haslinda Amin speaks with executives from Robinhood, Ethereum, and Circle. More ahead on the Asia trade. This is Bloomberg. As we weigh out the risk from the U.S. government shutdown, let's take a look at how the havens are faring. The dollar has been eclipsed by what we're expecting on the Federal Reserve's rate trajectory. For the moment, 1,200 on the Bloomberg Dollar Index, but it has been declining the past couple of sessions. Gold is reversing a bit from its record highs. We're seeing a tick up on the U.S. 10-year, still at the 409 level. And of course, yen has seemed to recoup its haven status amid all this. Let's talk more about the outlook for gold and bring in Bloomberg Asia Metals and Mining reporter Sibylla Gross for us. So, Sibylla, everybody seems to be piling into gold. You're talking about central banks, you're talking about haven demand, the geopolitical backdrop. Are we due for a reversal?
Look, it's hard to see sort of the structural demand or drivers here, bullish drivers going away for gold, right? Like, we have seen a bit of a breather this morning, but we've seen some pullbacks, but they don't last very long, and they're very shallow. We've seen investors willing to jump back in on any kind of pullback. So it's hard to see any significant headwinds for gold, given sort of the factors you just mentioned there. Obviously, the US shutdown is sort of the latest development here. It makes reading the task of reading the economy even more difficult than it already was. Markets are now having to rely on private data, and we're seeing all the banks on Wall Street, lift their forecast. Macquarie just yesterday lifted their forecast for gold in the first quarter to 4,000, and they're citing concerns really about the Federal Reserve's independence. And I don't think we're going to see those worries fade away anytime soon, despite the ruling that we had from the Supreme Court overnight in Asia hours, because we're just seeing President Trump, very willing to continue his attacks on the Fed.
Right. So that really leading not only to the record highs in gold, which of course we're seeing a little bit of a pullback, but also silver, also platinum.
Yeah, definitely. I mean, silver and platinum, they're also precious metals, so they're getting a bit of a harder run than gold, because we're seeing some of these macro drivers play out for the precious metal aspects of these commodities. But silver and platinum are also industrial metals, right? And we've seen years of supply deficits for both of these metals, and they're really coming to a bit of a head right now. We're seeing investors pile into ETFs, particularly for silver, and that's adding to extreme tightness in the market, unprecedented really. It's lasted for most of this year. The other factor playing out for both of these metals are fears swirling about on the tariff front. Right. Now, obviously, precious metals were exempted from tariffs, but we've got the President Trump's investigation of critical minerals, and there are fears they could be swept up in that investigation.
Sibylla Gross, good to have you with us, Bloomberg Asia Metals and Mining reporter, with that incredible rally that we've seen in precious metals. Take a look at the rally that we are seeing across Asia right now. China futures ended the session higher. Mainland China closed, but we are watching the Hong Kong Open, given that U.S. ADRs gained overnight. S&P futures not doing much at the moment, but after rising in the overnight session, despite that U.S. government shutdown. But it's really all about the tech trade today, because the Kospi is at a record high. Samsung, SK Hynix gaining on that investment deal with OpenAI, and you can see TAIEX futures upside at the moment. This is Bloomberg.